All right, ladies and gentlemen, I hope you had a wonderful day. It was a lot more calm in the market today. At least, I don't know, it felt kind of weird in the morning, depending on how you were looking at it. We were all over the place, spent 7 hours to do nothing, but the dollar calmed down. Depending on where you looked at the curve, things calmed down a little bit. It wasn't like we had movement, and this is after weeks and weeks of carnage, but now, tomorrow morning, we have the main event, the non-farm payrolls. This is one of two events. We have the non-farms tomorrow, then Thursday next week is the CPI, but this is going to be the said all be all. So I'm going to go over what we have tomorrow. I'm going to break down what I expect to happen and what reaction to look for. It should be very simple. However, if there is no big beats or misses on the data, just don't forget right here, September 1st, that was your last non-farm payrolls. You go back to August 3rd, this was your other non-farm payrolls. Pretty much, the market was around the same price, and you could see how it moved on those days, but we might get a lot of movement, but if it doesn't give us anything that pushes the narrative or that we can tie into CPI, the real main event is going to be next week. So I'm ready for tomorrow, and if you don't know, baby, we are going to be live 1 hour before the bell. This is important data. I'm going to wake up even earlier, and we will be there. YouTube.com/the stock market. We will have the data and interpretation live. But besides that, I need you to like the video, drop that thumbs up. And the other thing I'm going to talk about today is I am going to strike fear into your hearts over the bonds. Yeah, we're going to talk a little bit about bonds, and hopefully you've realized by now why everybody around the world in financial markets are reacting to it. And in all seriousness, I'm not here to strike fear in it. And what I want you to actually see with the bonds is what people were expecting this year, and now the next thing you got to be looking out for. It's quite simple. So it's going to be a good video. I hope you're ready for it, but now, run it, baby.
On the way, another day, it's a blessing. Make a play, either way, it's a lesson. It ain't safe, that's okay, we ain't stressing. Play in my position before I ever play a victim. So let me at it, bro. Spirit on the bend to go. I ain't bowing to you.
But right off the bat, I already showed you the dates of the last non-farms, and all you have to understand for tomorrow, the number that is expected is 170. If this number is lower, if the actual number comes in lower, the bonds are going to like that, and that will be good for the markets. The more under 170, the better for the markets. Even at 170, that's going to give you one of these weird reactions. And why I'm bringing this up and why I want you to see the last times that we had the non-farms. I don't know if I keep calling it CPI. That's the next event. It's on my mind, baby. But the non-farms, the thing about it, every other release, it's been a surprise of like 20 to 37,000. Now, obviously, the revisions, you got to go back. You could even go back on the stream when we've had it live and see the numbers when they come back if you want the originals, because by the time you're looking, you are getting revised numbers. But the whole logic here is we've gotten these like minimal reactions. It didn't really drive the narrative if it was about 30 to 20,000 above or below. So below will be much welcomed given how bad the bonds are, and that is really what we want to see. Remember, even job openings, anything, even though ADP, there was a lot of other factors yesterday, the fact is it's a very easy number to react to. Eventually it'll get revised, and then people are going to try to pick out the nitty gritty, but it's simple. This number comes in low, we are going to have a good time. If this number comes in higher, even 20,000 above 40,000, that will still be negative, but anything even above that, then you might even watch the next problem and what I want to talk about with the bonds. So that's all for tomorrow. Like I said, going to be very simple. You don't need to overthink it, and you also need to be prepared for maybe we get a little bit of movement and maybe it ends up like the other ones and the real moves happen in the follow-up with the CPI, because that's how everything else has already played out. So keep that in mind. I hope you're ready for it. But now let's talk about the bonds. And what I want to talk about is every single day we've been bringing this up, and people are worried about it. Some people aren't. They say it's going to bounce. Should I buy TLT? There's so many things going on right now, but hopefully you have been able to get a grasp that bond yields around the world, they are all going at a rapid pace, some more than others, and especially in the United States, their bond yields, our bond yields, are going crazy right now. It's already moved up about 1% in the quarter on the 10-year. Now, why this is so important and why everyone's bringing this up and why we're freaking out, because at other times when we started climbing up, here's the reality. We have freaked out every time we have entered a new realm of rates without something breaking because we have not been used to it over the last 50 years. So shout out to Hugh Hendry, baby. He talks about the 50-year bull market in bonds absolutely dying since 2020, and that's what you see right here. So why this is so important all of a sudden, because we need to see what the next level is and can we handle it. Is the bond market dead? No, but it is on its way to dying, and that's why people are worried. So every time you make a crazy climb like this and start entering into other levels, it starts to disrupt many, many things. So why? Why would that? How does it disrupt? Is it because it's a solid number? It's a number. What's going on? It is very simple. And to get to the bottom of this, you're going to go through a lot of data. There is 68 or 80 qualified economists, depending on the survey. The data is very privatized to a degree, but there's ways to go about and get it. But what I want you to understand, we'll go to this article from last month a little later, but go look around, go check all of the news over the last year. And the fact of the matter is, there is no real consensus of market participants or economists who believe that the rates were going to go above 5% this year. No matter any way you chopped it up, no economists believe that we would go higher than 5%. So the real question for last year, everybody was asking, will the rates go back to the October lows? That's what we recently dropped. So this whole week that we've gone through, nobody expected this to happen, and if this continues to the end of the year, not many people are prepared for that. So hopefully you see why things get disruptive, because if economists are off guard, businesses, how do people hedge? How do they plan investments? If you were planning to refinance, there are so many factors that goes into it, but this is what is stopping or getting people to be like, whoa, what's going on right now? Because quite frankly, nobody expected that we would be above 5%. So we'll go through the expectations a little bit more, but let me give you the next piece of the pie. This is related to tomorrow, what we get on the data, then related to next week with the CPI. It's very simple. Are rates going to go above 5% or not after all of this? There was talk about it today. I don't know if it was Bill Ackman. Somebody in the news media was bringing this up, but I agree with it wholeheartedly. This is what we have to be watching for. And again, is something going to break? No, we have to get to the levels, and we're going to see which level, every number, 4, 5, 6, 7, Powell is trying to test what we could survive. Yeah. But the main point is, this week now, these events leading into earnings, even all of this, will that get you above 5, or will that keep you below 5? We stay below 5. We don't have to worry about that for this year. Hopefully, earnings are good. You're going to be good to go. We do break above 5. The story starts to get a little bit weird, and the fact of the matter is, you're on a straight shot to it. At one point, you were less than a quarter point away from that. You get one bad week, you're going to break that. And again, economists, everybody, they were caught off guard with this move, and it makes sense why, because this does not really happen. Oh, that's a 10-year bomb. So I'm on the 1-year chart. But we brought this up every time, every single level. So that's why some of you love it. Some of you are sick of hearing about it, but hopefully you see why. It's very simple. People are paying attention to this all around the world. As the rates go up, so is the risk, the credit risk, collateral, banks. There's a lot of different things. You're watching oil and drop out of nowhere, but the whole fact of the matter is, if that develops above 5, we're going to watch people respond. If it doesn't, things calm down, then that was a close one. So keep that in mind. And now back to the expectations. Final thing, it's just like I'm saying, to even prove the point a little bit, this article is from 1 month ago. And even 1 month ago, people were, it's like JP Morgan, and they're saying that the median forecast for the 10-year note was 3.6 the quarter before this article, and then that got upgraded to about 4.03, and it has like a high of 4.34 of last October. So you even go down, where was it? I think there's one more part. It said an overwhelming 81% majority of respondents to an additional question, 29 of 36, said that the 10-year would not revisit October highs of 4.34 3-4 at any point of this cycle. The remaining 7 said that it would, with most expecting that it would happen this year. So go through all this and how they get all of this stuff too. You could even read a little bit more about it. There's all of these things. So you have the Philly Fed. They have their own like budget and estimate and projections. You have the CBO. You even have Fannie Mae forecasts. So it's like all economic forecasts. It's the data. It's the Fed. It's the futures, the Fed futures. It's all of this stuff going in. And this is what the so-called quote-unquote qualified economists are using to come up with their forecast for the years. And honestly, we do trade on a lot of it, or at least data. Think about the Fed. I mean, these are all government organizations to a degree, or they all CBOE, St. Louis Fed, Fannie Mae. So the point is, all of these estimates this whole year, and we've been raising them up the whole time, but like, dude, nobody thought you were going to get to 5 at all, let alone people were even doubting that you would have gotten to 4.3 by this year. So that's why everybody's been freaking out. If it does happen, a lot of people are still off guard, and we still have data that's just either going to confirm or deny all of it. So I hope you're ready for it. I hope I see you in the morning, but now let us get into the plays. So right off the bat, I got a couple of plays. I mean, we're going to see what the data does, see if that gives us trades. I didn't make any trades today. I forgot to mention yesterday the MGM puts that we bought, I made those free. So I had 200 puts. I sold 130 out for a little bit more than like 50, 60%. Got my initial investment back, and now I'm out of that play. But I talked about this play yesterday on the watch list, MRTX. I flipped out of it for a $3 loss. I was like, all right, I didn't want to wait. And we were talking about this being the sympathy trade to Newville. Well, we were correct on there. I was saying how this was the only one that responded yesterday, but it didn't have a move yesterday. Then all of a sudden it was up 17%. And then they had news that Sanofi, you guys remember PRVB, they ended up buying out PRVB too. Sanofi, they wanted MRTX. There was a potential buyout offer, and of course it was linked to the Newville drug approval, I'm pretty sure. So great play if you got it, but the highlight of this is that sympathy played out. We saw a little sign yesterday. That's a little nugget I'm taking over it. I'm like, shucks, I wish I had that one. It would have been a great W, but at the end of the day, we had a little info, but that was some news right there, and you got it on the watch list. At least you had a lot of time either way, so hopefully you got some profits if you held on to that. If not, we will find another, but that's play number 1. Then play number 2, Coca-Cola, bro. If you did not see what happened today, watch Coke, Pepsi, Constellation, anything with food in it. It really kind of even started with Walmart. CEO is talking about Ozempic, leading to people buying less calories. The Cheez-Its Pringles CEO is even saying stuff, but overall, even after Constellation earnings, people were not feeling good about food products and the consumer. And remember yesterday, we were talking about the Euro consumer yesterday, and then you even had gasoline demand and a couple of other things, but for the most part, like, dude, some big blue chip names. You just saw utilities get clapped, a lot of defensives now. Some of these like consumer blue chip names, they are getting clapped. Even like Pepsi, I believe this was one of its biggest lows since like a year, and now it's on track for its worst year since 2008. But this was a death blow on there, kind of out of nowhere, and kind of fitting in the theme of even oil dropping randomly. And like I'm saying, utilities one after the other. It is very wild there. So watch out, because the next day after utilities, they did bounce. We'll see if that happens there, but that is play number 2. And then finally, play number 3 is GM. So they announced they're taking out a loan. It's like $6 billion. I don't know, the credit line that they're accessing it. It's part of the strikes, or it's because of it. Not, there's a lot you could assume, but that's the first thing, but that's not the main event that I'm bringing up with this. It is the fact that they had some news about like a recall and airbags of like 20 million vehicles. They said it's potential. NHTSA, I believe, or one of those boards is looking into it. But if it does spread to many vehicles, that could be bad, even with the UAW strike. It reminds me of Tata Motors back in the day and the airbag issue. If they have that many cars with that, that would be a big problem. So want to see how that plays out. It had a little weird reaction today, but keep that on watch. And with every play, watch them all tentatively, because it is all going to boil down to the data. So Chad, that is everything. I don't have anything else. I'm going to be there bright and early. I might even be playing 2K on Twitch tonight if I see you there, but I will see you in the morning, and That is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember the helmet. The helmet is the head. The armor is so important. But your head is very important because it is vulnerable. And if you don't protect your head, then what good is the rest of the armor? Don't forget what the helmet means, my friend. So, Chad, stay in the game. I will see you very shortly. I've told you that like 5 times in the last minute right now. But either way, I'm just hyped. Let's close out Friday. Let's close out a weekend. Welcome to the October. It's already first week. Oh, my gosh. Hard knock.